So audit and assurance. So let's start the last class of our session, audit and assurance. And straight away, we are moving towards our question. Both are better. Just practice. BPP is much better. Okay. Let's have a question. Question 81, 82 first. Question 82. ISA 210 agreeing the term of audit engagement. Before signing letter of engagement, we need to agree term of engagement with the client. An auditor to establish whether the preconditions for an audit are present prior to accepting an audit engagement. Describe preconditions for an audit. Describe preconditions for an audit that Danak and company should have established prior to accepting the audit of ESK company. We have discussed about preconditions of an audit. What were the 5 preconditions? Ensure financial statements are prepared as per applicable financial reporting framework and agree the responsibility of management regarding their acknowledgement, like preparation of financial statements is the responsibility of company management. Implementation of internal control system is the responsibility of company management. Providing all information to auditor relating to audit purpose is the responsibility of company management. And providing unrestricted access to company records for audit purpose is the responsibility of company management. Correct. 4 marks. If you know preconditions, you will get 4 complete marks. And if you are not aware of this topic, these 4 marks lost. Mean rest. From 96, you have to get 50 to pass the paper. Part B. Using the table below. Oh yeah, there is below table. Using the table below, calculate the following 4 ratios for both years to assist you in planning the audit of ESK, gross profit margin, inventory holding period, receivable collection period, and payable payment period. We need to calculate 4 ratios: GP margin, inventory days, payable days, receivable days. Good luck, everybody. Come on. This is the data we are having. We are having a revenue figure, cost of sale figure for both years, 20x5, 20x4. Gross profit, inventory figure for both year, receivable figure for both year, payable figure for both year. You need to calculate GP margin, GP over sale into 100. GP over sale into 100. GP over sale into 100. Which question number is 81. Sorry, 82. ESK company. 82. Please, GP margin For 20x4 and 20x5, GP over sale into 100. 3 GP margin are 27.2 for 20x4 or 5? 5. 27.2. And for 20x4? 29.8. Please confirm it. 7.6 over 27.5 into 100. 7.6. Now calculate receivable days, inventory days, payable days. Receivable days, receivable over credit sale into 365. Receivable divided by credit sales multiplied by 365 days in a year. The answer will be in days. We have learned ratios in
85.
financial accounting.
85 days.
85 for 20x4 or 5?
85.
85 for 20x5 or 4?
20.
20x4 or 20x5? We need to calculate for both years.
25,
Eight-
sir. 25.
85 for
days
20x5 and 65 for 20x4.
Yeah.
But what inventory days? Inventory over cost of sale into 365. Inventory over cost of sale into 365.
That is 134. 135 days.
135 days for 20x5.
20x5.
Okay, what about 20x4?
That is 117 days.
117 days.
Yeah.
So please calculate payable days, receivable days, payable days, payables over purchases into 365. We don't have purchases, so we can use cost of sale. For both years.
No, only 2005.
For both years. Don't forget to take calculator with you while going for this paper.
$67.87.
Any paper of ACCA, you need to take calculator with you. Either it's audit, either it's even business and technology. In all paper of ACCA, calculator must be with you. A good calculator that you use in your routine life. Don't spare a separate good quality calculator that is just for exam paper. No, the routine calculator that you use in your routine. So we have calculated 4 ratios for both years. Please, GP margin for 20x5, 27.2, while 20x4, 27.6. And what about the inventory holding period for 20x5? 135 days,
17 days.
170 days, 117,
117.
117. Okay. And what about receivable days for 20x5?
That is 85 days.
85 days. And while for 20x4,
That is 65 days.
65 days. And what about 20x5 payable days?
That is 39 days.
39 days. And for 20x4,
That is 64 days.
64 days. 64 days. This is in percentage. This means GP margin almost same. Inventory days has increased. What could be the reason behind increase in inventory days, inventory holding period? From 117 even is too much, about 4 months. Might be obsolete inventories there, for which company haven't booked the losses, due to which inventory could be overstated. Why receivable days has been increased? Might be there are some debts that are uncollectible and company haven't created a premium for irrecoverable debts. So due to this, asset profit could be overstated. Why payable days has been decreased? How you can pay faster? Your cash is stuck in receivable, your cash is stuck in inventory. How you are paying faster? Might be there is any omission of payables. There is any omission of payables. That's why it has been reduced, because numerator has been reduced. Reduction. Okay. So requirement A, requirement B, we have completed for 8 marks. Easy 8 marks. That are very helping to pass this paper. Now you have to score 42 out of 92. Because for ratio answer, there is no chance of reduction in marks. You will get full marks. For 4 preconditions, there's no chance of losing marks. You will get complete full. Part C of the question for 16 good marks. Using the information provided and ratio calculated, describe 8 audit risks and explain the auditor's response to each risk in planning the audit of ESK company. Meaning you need to identify 8 audit risks and auditor response. Response means audit procedures. What procedures you will perform, how you will check these things, whether there is a misstatement this relating to this or not. In question scenario, if we are having any risk relating to inventory, we will relate this ratio with that. If there is any information about receivable, we will relate this to that. If there is any information relating to payable, we will relate this to that. If there is any chance of sale overstatement, we will relate this to that. If there is no information regarding the sales, inventory, receivables, payables, so then we can write about them separately using the ratios only. Let's see how we can relate if there is any information of inventory, receivables, or payables, or sales. But we need to write down 8 audit risks along with response. This scenario relate to 4 requirements A, B, C, D. A, B we have covered. We are in requirement C. It is the 1st July 20x5. You are an audit supervisor with the Pennock and Company and are responsible for planning the audit of new client ESK Company for the year ending 31st August 20x5. Your audit manager recently met with the finance director of ESK Company and has provided you the following planning meeting notes and financial statements extracts. Planning meeting notes, ESK Company is manufacturer and wholesaler of plumbing supplies. It operates from 2 warehouses which are situated in the north and south of the country. Extracts from the forecasted financial statements for the year ending 31st August 20x5 and the financial statements for 20x5 are as follows. And we have used that data. In September 20x4, ESK Company purchased a patent for $2.6 million. Patent, intangible asset. Intangible asset. That should be capitalized and should be amortized over its useful life, which give it the exclusive right to manufacture a waste disposal system for 4-year period. Mean company will manufacture any waste disposal system and the patent is for 4 years. Mean nobody else can manufacture this waste disposal system except you. If it is for 4 years, this means 4 year is a life against which it should be amortized. The purchase cost capitalized comprises the cost of the patent. That's fine. And the other costs such as legal fee, that's fine. And administrative cost incurred in negotiating the contract. Purchase cost, legal fee, that's fine. That meet the capitalized cost criteria. But administrative cost should be expense out, should not be capitalized. If company capitalizing administrative cost, chances that asset profit could be overstated and expenses understated. Legal fee obviously is relating to patent. Without that, we cannot get the patent. So first risk, overstatement of asset profit, understatement of expenses. How we will verify this? We will review the breakdown of revenue and capital expenditure. Review the breakdown. Mean there will be a document having breakdown of revenue and capital expenditure and compare with invoices of expenditure. to ensure the expenditure is properly classified according to its nature. Mean through invoices, we will able to identify whether this cost is meeting capitalized criteria, should be included in capitalized mean asset. If it is meeting a revenue criteria, should be expense out. So we will review breakdown and compare with invoices to see whether the breakdown of revenue capital expenditure is accurate or not. What else? If management still say no, this cost should be placed. Discuss with management. Regarding capitalization of admin cost to see if reasonable, mean whether their talk, their saying, discussion, they can provide any evidence this is capital nature, or we will provide evidence this is revenue nature to see if their intention is reasonable. What else could be the issue? If company do not amortize the patents over its useful life, chances that asset profit could be overstated, expenses understated. How we will check whether amortization is done properly or not? Recalculate. Recalculate amortization of patent using the rate useful life and policy. Also compare with management calculation for accuracy. The same procedure we applied in a non-current assets for depreciation. Instead of word depreciation, I have changed the word amortization. Is it fine? This is called auditor response, mean how you will verify it during audit. This is relating to what? Patent.
For two audit risk, two audit risk,
This is response to risk.
but there's two audit risk.
There are two audit risks, and against audit risk, this is the response. In response column, you will write down the procedure. In a risk column, you will write down the audit risk. Is it fine? Okay, in order to finance this purchase, ESK company obtained an interest-bearing bank loan of 2.5 million during the year. They have obtained bank loan of 2.5 million. The bank loan is payable in 5 equal annual installments, with the first installment due to be paid on 1st September 20x5. When they have obtained the loan in 20x4, what's the year end of our client? 31st August 20x5. So installment need to be paid in 1st September 2025, but it should be recorded in current year because loan installment relating to current year should be recorded, or if you're gonna pay in future, it should be accrued for. There should be liability recorded. And interest relating to this loan should be accounted for in correct period. For current year interest, obviously, if you have obtained on 1st September, year end is 31st August 20. So from 1st September till 31st August, interest should be recorded in current year. If you're gonna pay in future, there should be interest expense debit and interest payable credit. So chances that if interest on loan is not recorded, is not accounted for in current year, either profit could be overstated and expenses, liabilities could be understated.
What exactly is this?
Company have obtained a loan of 2.5 million. If they have obtained a loan, this means they need to record interest. Though first installment will be paid in 1st September. And normally we pay interest with the installment. So normally we pay interest with the installment, but the interest of current year should be recorded in current year. Though we're gonna pay in next year, but interest of current period should be recorded in current year. If we are paying in current year, interest expense debit, cash credit. If we're gonna pay in future, interest expense debit, accrued interest, interest payable mean liability should be credit. If company is not recording interest in current year, like interest debit, liability credit, so chances that expenses could be understated, liabilities could be understated, and if expenses understated, what could be overstated? Profit. Is that fine? And for the installment of first installment should be recorded under current liability. The remaining amount should be recorded as non-current liability, mean there should be classification of current and non-current liabilities. The amount you're gonna pay within 12 months should be recorded as current liability. The amount you're gonna pay more than 12 months, that should be recorded as non-current liability. So there should be classification of current and non-current liabilities relating to the installments. If you have obtained a loan for 5 years, so 4 years installment should be recorded as non-current liability, and 1 year installment should be recorded as current liability. So if company have not classified the current year installment into current liabilities, chances that current liabilities could be understated and non-current liabilities could be overstated. Risk. Is that fine? What could be the response against it? Loan and interest, this is the issue. I'm not writing audit risk. Assume you will write by yourself. I'm writing response only. Means second column I'm writing. Okay, what you need to do? Review terms of loan are first we need to calculate the interest. Recalculate. Interest expense using the rate and compare with management calculation for accuracy. In how much interest they are recording, how much should have been recorded. And there is a problem of misclassification of current and non-current liabilities. So for that, we can review financial statements, copy, to ensure accurate classification of current and non-current liabilities. Or we can discuss with management regarding their intention to account for this loan and classification of current and non-current liabilities. Is that fine? Audit risk and response mean how you will verify this during audit, the problem you have identified in risk. Okay, moving next. The payable ledger clerk has recently discovered a batch of supplier invoices that had been miscoded and therefore had not been recorded as trade payable. That's why payable days has been decreased to 39 days. If due to this error, payables have not been recorded. This error has now been corrected, but investigations are still ongoing to determine how this happened and whether any other batches of invoices have been miscoded. So there is error in miscoded invoices. Due to this, payable balances have not been recorded, and there could be chances other balances may contain error. So payables could be understated. As there is instances from the payable days that has been decreased from this days, 64 days to 39 days, indicating payables could be understated. Not only payable, purchases and payables could be understated. Purchases and payables could be understated.
Writing the audit risks, so we have to mention it there, like which type of it.
No need to mention this. If you are using the word misstatement, any understatement, overstatement, understood, it's an inherent risk. Is it fine? Along with control risk, detection risk, you can use the word it is detection risk, it is control risk. But with inherent risk, you don't need to mention its inherent risk.
They're very rare to find in.
Exactly. Because mostly there are inherent risks. How to verify payables? We have learned the procedures. Payables understated. But you will verify completeness. Completeness ensure whether the balance is understated or not. How you will verify? Trace a sample of purchase or acquisition in the purchase system to verify there are relevant purchase orders, GRNs, purchase invoices, and entry into purchases and payable ledger balances. I'm not going to write complete sentence. The same we have learned in tables. What else we can do? Reconciliation, reconcile. What? Payable, ledger balances. To what? To supplier statement. Because through comparison, we will be able to identify whether payables are different or same. If they are same, there is no chance of understatement. If they are different, this means they are understated. To supplier statement, to ensure differences investigated and adjusted to ledger balances. What else we can do? We can inspect post year end cash payments. Because for receivable, we need to inspect post year end cash receipts. For payable, inspection of post year end cash payments to ensure liability was recorded against payment to suppliers. And these all three procedures we have learned in papers. Just we need to pick which is most relevant. Is it fine? What else we can do? We can perform independent confirmation of the balances from supplier. Can we move forward? Is it fine? There was a fire in the South warehouse in June 20x5, which resulted in damaged inventory. An inventory count immediately following the fire identified that inventory costing $1.5 million required to be fully written off. And if that inventory is not written off, chances that inventory profit could be overstated and expenses understated. As the evidence shown, inventory days has increased from 117 to 135 days. So there might be chances obsolete damaged inventory other than this fire damage is also included in the inventory. The damaged inventory has not yet been replaced as there is a sufficient inventory in a north warehouse to satisfy demand. The director have raised a claim against ESK company insurance company to cover the full extent of the lost inventory. But until here, we can write down there is chances that inventory could be overstated, profit overstated, and expenses understated. How we can verify whether damaged inventory is there or not? How we can verify? They have performed inventory count immediately after the fire in. And inventory count immediately followed the fire. So what we will do? Review the inventory count sheets. To identify damaged or obsolete inventory requiring adjustment. Discuss with management regarding their treatment. To adjust the damaged inventory. Is that? The directors have raised a claim against ESK company, insurance company, to cover the full extent of the lost inventory. This inventory is insured and they have made a claim against insurance company. Although no confirmation has been received from the insurance company, the directors are confident that the full amount claim of 1.1 million will be received and have included this amount as the receivable within the current asset. If you haven't heard anything from insurance company, you cannot record this as other receivable
Yes.
because this is not certain. If there are chances above 50% mean probability of future economic inflow, it should be recorded as disclosed as contingent asset rather than accounted for as a receivable asset. What's the accounting standard on contingent asset? IAS 37, if you provide the number, examiner will be happy. They might hand it over your distinction in this paper. Keep the examiner happy. Impress the examiner. So chances that asset could be overstated and disclosure understated. How you will verify this? Discuss with management. Regarding the likelihood of insurance claim to see if reasonable. In how you are saying that you will be able to receive this amount, what are the chances? If chances are even below 50, there shouldn't be any contingent asset in. If the chances are too remote, mean above 95%, then there should be asset. If chances are above 50, below 95%, there should be contingent asset. What else we can do? Review any correspondence. What is meant by correspondence? Communication with whom? Insurance company. Regarding chances of loss recovery from the
How many do we need to write?
at least two. Against each risk, at least two. At least two. If you are unable to write down two, at least one should be there. Okay, let's move. So we have linked payable days here. We have linked inventory days here. ESK company sales staff receive a bonus if they meet sales target each quarter. If required target is not met, there are chances of manipulation in results like overstatement of sales by creating fictitious sales. A high level of sales bonus is available in the quarter to 31st August each year, especially at the year end, to get the bonus as a reward for efforts during the year as a whole. ASK offers its regular customer discount up to 10%. Why? So that they should be encouraged to buy more. There should be more sales to get the bonus, which are negotiated and documented by the sales director. That's fine. This year, in order to, sorry, my gosh, I've done something wrong. Control Z, Control Z, Control Z, Control Z. Yes. So this year, in order to easily monitor the amount of customer discount, they have been recorded separately as an expense in cost of sale. In previous years, revenue has been recorded net of discount. Why they are not recording in current year net of discount? Obviously, if we will deduct this discount from sales, sale will be understated. They have charged to where? Cost of sale. So there are chances sale could be overstated as well as cost of sale. And due to this might be our GP margin is same as compared to previous year. I mean, there is no change in GP margin as company have increased the sale. I mean, there is increase in sale like 27.5 to 30.9. But there is even GP has been increased, but there is no change in GP margin because due to this misclassification, sale and cost of sale could be overstated.
One about the
One about the bonus, but it's relating to sale only.
bonus and one about the cost.
It's better to write down combined. If you write down as two, that will be fine. No issue with that. Like for discount, you can write down separate, and for bonus, you can write down separate. So due to bonus element relating to sales, chances that manipulation of sales could be overstated. How we can verify overstatement of sale?
It's
Trace a sample of sales ledger balances to relevant sales invoices and dispatch notes and sale order to ensure that sale is supported by invoices, dispatches, and orders. I mean, this is not fictitious. There could be chances of cutoff errors as well. They might be recording in next year's sale to current year because there are problem mainly in the last quarter. Because at year end, they need to measure the sale, you know. So at year end, there could be chances of cut off, means sale could be overstated due to cut off errors. This is another risk along with bonus. So we need to perform cut off testing like
in the sample.
tracing a sample of dispatch notes of last week of current period and first week of next period to relevant invoices and ledger balances to ensure sales have been recorded in their correct period. Do I need to write down? It's fine. Okay. And what about now we will say discount. Instead of netting of discount to sale, company have recorded it into cost of sale. Due to this, sale cost of sale could be overstated. As the evidence from GP margin, there is no change in GP margin despite sale and GP has increased as compared to previous year. The chances that sales cost of sale could be overstated. How we will verify this? How we will verify this issue? There is misstatement. By how much amount? Recalculate amount of discount. Recalculate amount of discount using the sale invoices. To confirm the misclassified amount. Because if we're going to discuss with management, obviously we need to provide the amount. For what amount there is a misstatement. What else we need to do? What else we need to do? Discuss with management. The reason behind change in policy. The reason behind change in policy of recording discount to cost of sale to see if reasonable. Because through their discussion, we'll be able to identify what is the motivation behind this, why they are doing this. Yeah. So we have used GP margin as well. We have used inventory. We have used payable. Let's see. The manager in ESK company's credit control department has been off work since December 20x4. Mean credit control manager is not there who need to manage credit control mean receivables. Due to ill health and has been replaced by an inexperienced temporary manager. As a result, ESK company has not been monitoring the aging of its receivable. They are not recovering. They are not chasing up the receivable. Mean receivable reconciliation with the control account or receivable age analysis is not performed properly. And only follow up outstanding invoices when the system alert credit control that a customer invoice has been outstanding for 90 days or more. The standard credit terms are 30 days, while receivable days have been increased from 65 days to 85 days. So chances that provision for irrecoverable debt is not properly recorded, adjusted because age analysis has not been performed on regular basis and receivables are not chased up. So due to this, receivable profits could be overstated and expenses understated. You know? And we have learned procedures to verify receivables. Inspection of post-year and cash receipts. Inspection of post-year and cash receipts to verify cash has been received from the debtors. What else? Independent confirmation of balances from the customer. Mean perform circularization, i.e. independent confirmation of balances from the customer. Or we can review copy of receivable age analysis to verify provision for doubtful debt has been created properly. Mean the valuation and ownership procedure of receivables we will apply here. In the cramming of receivable procedure we need to apply here. Valuation and ownership. Is it fine? We have used all the ratios. During the year, ESK company was informed by the tax authorities that it was under investigation for a breach of legislation relating to sales tax. Investigation, breach of law. There will be chances of fines, penalties. Chances of fines, penalties. Probability of future outflow. Per IAS 37, there should be provision. What is the accounting entry of provision? expense debit, provision liability credit. If company has not accounted for provision, profit could be overstated and expenses, liabilities could be understated. ESK company has appointed a tax consultant who has advised that there does appear to have been a breach of tax legislation. Even consultant is saying, yes, there is breach of tax legislation, and has estimated that a fine and penalty totaling 0.6 million will be payable. Amount is known as well. Will be payable mean probability. The director do not intend to record anything in the financial statements until final notification is provided by the tax authority. Okay, do not need to record liability, but provision should be accounted for, which is due to be received on 31st January 2026. But it's meeting the criteria of provision, present legal obligation from past event, probability of future economic outflow as per consultants, and amount can be measured liability 0.6 million. What could be the response? Discuss with management directors regarding their intention to account for this tax authority issue to see if reasonable. Is that matter involving judgment estimate as well? Obtain written representation from management regarding reasonable estimates. Because if they are saying no need for creating provision because we will settle down something like that, so we will discuss and obtain written representation. What else we can do? Is there any consultant or lawyer involved? So we can consult the consultant or lawyer to ensure the likelihood of payment. In how much chances are there, whether above 50%, below 50%. Obviously, if tax authority is making investigation and they have a make a claim of 0.6 million, this means tax authorities you cannot deny. You cannot avoid easily. How many risks we have identified? From first paragraph, we have identified one patent, one relating to loan, third payables, fourth relating to inventory, fifth relating to contingent asset, six relating to bonus, seven relating to discount, eight relating to receivables, ninth relating to provisions. But you have to identify at least eight. Is there any other requirement? Yes, there is a requirement D, and you know the answer. I'm 100% sure you know the answer. Describes substantive procedure the auditor should perform to obtain sufficient appropriate audit evidence in relation to ESK's trade receivable. We have learned procedures of trade receivables, just vomit those procedures wrong. Compare current year balance with previous year to investigate unexpected fluctuation. Then for valuation, completeness, ownership, existence. Straightforward. 6 marks. Easy. 30 marks are difficult. Part C is time consuming. Part A, B are easy. Part B in this question is. Okay. Now move towards. We left some procedures, some topics. Let's cover those. Then why you are performing this procedure, you need to write down a purpose. Even, but in this question, risk with response, you have already written down the purpose in risk.
Substantive procedure for the sales like.
Yeah. Okay, how to verify interest expense or interest income? Inspect loan agreement copy. Why? To verify the amount and interest rate. If you are verifying interest income, then investment copy, like deposit into any bank account copy to verify amount and interest rate. Confirm interest payment and receipt from where? From cash book. Recording in the cash book. Compare current year balances with the previous year to investigate unexpected fluctuation mean perform analytical procedure. What else we can do? Recalculate interest expense or interest income using the rate and amount and compare with management calculation for accuracy. In how to verify interest. The question we have covered, there was issue of interest. How to verify provision for doubtful debts. Consider the basis and adequacy of provision. Even omitted. Obtain aging report of receivable and test its accuracy, mean review copy of age analysis of receivable. Compare aging with credit policy of company, identifying long outstanding debtors, ensure they are provided for. Omit the first one. Consider basis and adequacy of provision, mean the provision company have recorded. You need to verify whether they are adequate, mean proper amount or not. Mean review provision and confirm adequacy as per the reports. So what is second? Review age analysis copy. Compare with credit policy to see whether outstanding debts has been provided for. Has been provided for mean provision for doubtful has been provision for doubtful debt has been created or not. Provision for irrecoverable debt has been created or not. Mean bad debts are recorded or. Inquire about disputed receivables, inspect customer correspondence and board minutes for evidence of dispute and expected recovery. And if company management saying no need for provision for doubtful debts, or will recover the amount, what we need to do? We need to review correspondence with the customer and board minutes to verify any chance of recovery. If company haven't recorded the bad debts, what we will do? Review post year end cash receipts to verify cash has been recorded from received from overdue debts. Because if cash has not been received, then we will ask the management, please record bad debts. There could be some amounts, management saying no, we will recover. So we'll check the correspondence with the customer and we will review the post year end cash receipts. Assess historical accuracy of provision for bad debts by comparing with previous year. What are the normal bad debts amounts for the company? How to verify intangible assets? What's goodwill? What is goodwill? Goodwill. Difference between consideration paid and fair value of net assets acquired. In consolidated financial statements, we record goodwill. Otherwise, we never ever record goodwill. When you are buying any subsidiary, suppose subsidiary net asset means subsidiary worth is 100, but you have paid 120. So what is 120 consideration paid? What is 100? Fair value of net assets acquired. And the difference between these two, what is that? 20 goodwill due to repute of that business. How you will verify goodwill? First, you need to verify consideration paid. From where you can verify consideration paid? The amount you have paid, from where you will verify? Inspection of cash book bank statement to verify the amounts paid. And there should be some agreement between both the companies. The purchase agreement, inspection of purchase agreement to verify the consideration paid. How you will verify net fair value of net assets acquired? How you will verify fair value of net assets acquired? Inspection of accounting records relating to fair value of net assets. Where fair value of assets is written in accounting records. It's inspection of accounting records to verify fair value of assets. And this goodwill is intangible asset. And intangible should be amortized over its useful life. Intangible assets should be amortized over its useful life, but goodwill never ever amortize because you cannot measure useful life of amortization. But there should be impairment of goodwill. What is impairment? You need to check the market value against your book value. If market value is lower, this means you need to impair, reduce the value of goodwill. If the sale of this brand are becoming down, this means repute has been down. So there is a impairment of goodwill. Let's see. Goodwill. Compare current year figure with previous year to investigate unexpected fluctuation, analytical procedure that we can fit in every account balance substantive procedure. If examiner asks to write down substantive procedure of this account balance, fit this. Compare current year balance with previous year to investigate unexpected fluctuation. Review board minutes for approval of acquisition of business if you have acquired business and created goodwill. So review board minutes regarding authorized to ensure authorization of acquired asset or subsidiary. Recompute the amount of goodwill. The difference between cost and fair value of net assets acquired compared with management calculation for accuracy. This goodwill amount we need to recalculate using the consideration paid and fair value of net assets acquired and compare with management calculation for accuracy whether the amount is the same or not. Inspect the purchase agreement and agree a cost of acquisition paid to cash book and bank statement. Inspection of cash book bank statement to verify amount paid or consideration paid. Inspect due diligence report. Before acquiring any company, we need to ask the consultant to calculate fair value of net assets acquired. And that consultant report where he has calculated the fair value of asset, that report is called due diligence report. Due diligence report is what? Report about fair value of asset or net worth of the company. That we normally perform from any specialized person. because companies having so many different types of asset and we are not having knowledge about different types of asset. So what is their value? We hire any consultant, any expert who will calculate the value of asset, and the calculation of value of asset report is called due diligence report. So what we need to do, inspect due diligence report, expert report for acquisition, and ensure that all identifiable assets have been included and reasonable value to mean fair value is reasonable. Assess the adequacy of disclosure related to goodwill in notes to the accounts. Mean against goodwill amount, there should be a detailed disclosure in the notes of the accounts, how this amount has been calculated. Mean what was the consideration paid, what was the fair value of asset, this should be disclosed in notes to accounts. Because in financial statements under asset, this amount is appearing 20. How this has been calculated? There should be a disclosure where notes to the accounts. Regarding impairment, no need to verify. Simply we can say recalculation, impairment, and compare with management calculation for accuracy. Development cost. IAS 38 is on intangible assets. IAS 38 is on intangible asset. According to IAS 38, intangible assets should be capitalized and should be amortized over its useful life. IAS 38 also covering research and development cost. According to IAS 38, research cost should be expense out. It should be charged, treated as expense in income statement, while development costs should be capitalized by meeting our criteria. If development cost meeting a criteria, it should be capitalized. Otherwise, it should also be expense out. What is research and what is development? Research, we have performed any investigation to find any formula to produce a product. If we couldn't find any formula to produce a product, expense. If we have found a formula to make any product and we have started production of that product, this means this is development cost. Mean research have been converted into development. But development cost will be capitalized, mean recorded as asset by meeting certain criteria. What is criteria? There should be technical feasibility. In developing this product is a technically feasible. Technical feasible mean realistic. There should be commercial viability. Commercial viability mean there should be demand in the market about the product we are going to develop. Mean we can generate revenue by selling this product. If there is no demand, we cannot generate revenue. It's not commercially viable. Commercially mean market. Intention to use, complete, or sell. Mean management should agree to either use this product, complete this product, or sell this product. If management intention is not there, they do not agree we can complete or sell this product, this means it's not meeting the criteria. Availability of resources. Mean company must be having resources to use, complete, or sell this product. Mean there should be financial resources, there should be human resources, there should be physical resources, machinery should be there. to produce this product. Finance should be there to produce and market this product. And cost can be measured reliably. Mean, what will be the total cost to produce this product? That should have been accurately, reliably calculated. It's not based on guess. Because we are going to capitalize the amount. How much amount? So that amount should be measured reliably. If development cost meeting this criteria should be capitalized. If not meeting any of this criteria, development cost should be expense out. How we will verify whether it is technical feasible? Mean realistically, company can produce this product, company can develop this product. How we can verify? Being auditor, how we can verify it is technical feasible? Review existence of similar product in the market. If similar products are there in the market, anybody other have developed, this means this company also can. Because through this, you are going to produce something unique, new, different. So review existence of similar products in the market. How we can verify commercial viability? Mean there is demand in the market. How we can verify? Inspection of order book. If company have received any order from the customer in advance. Customer contract. Or any correspondence with the customers. So how we can verify technical feasibility? Review existence of similar products in the market to verify technical feasibility of development cost, to ensure technical feasibility of development cost, similar products in market. How we can check technical feasibility, commercial viability? Mean there is demand. Inspection of order book. What else? Customer correspondence. Or contract with customer. Because if company have received any contract, have received any order, there is any communication with the customer, okay, I want to buy this, when this will be developed, we need this. This means there is commercial viability, mean demand in the market. So we can verify management is having willing to complete use this product. Discuss with management, or we can review board minutes, board meeting minutes. Because in meeting discussion, they have discussed about it. Through this, we will be able to identify their intention. So review of board meeting minutes to verify discussion about products. Or we can discuss whether management is having intention to use, complete, or sell this product. How we can verify companies having resources? How we can verify companies having resources? For financial, we can review cash flow forecast that we have used in going concern procedure. Cash flow forecast to verify companies having resources. Now we can check. Cost can be measured reliably. I mean, company have calculated cost. Before producing any product, company prepare its budget. How much material will be used, how much labor will be used, how much overheads will be used. So what we need to do, inspection of budget of cost card to verify amounts can be measured reliably. And development cost should be amortized over its useful life. How we can verify amortization? The way we verify depreciation, recalculate amortization using the rate, a policy and useful life and compare with management calculation for accuracy. If we are having doubts about the useful life, discuss with management the useful life of the development cost to ensure if reasonable. Is that development cost? Compare current year figure with previous year to investigate unexpected fluctuation. The universal procedure that we can fit in any account balance. Ensure that development cost is recognized only if criteria is met as per accounting standard. If criteria not met, it should be expense out. We need to ensure that. Discuss the project management to assess the feasibility of project and obtain representation from management regarding intention to complete use our cell mean for this. We can even obtain written representation from management. Intention to use complete our cell, obtain written representation from management regarding their intention to use complete or sell this product. For a sample of cost, inspect supporting documents, for example, development contract, billing, and timesheets like budgets, cost card to verify cost measured liability. Review development cost to verify that cost is appropriately classified and does not include research expenditure because research should be expense out. Discuss with management and review the possibility of impairment subsequent to recognition. But we need to check these criteria mainly. What is brand? Name, logo, slogan of any company that you are using to sell the product. And only purchase brand should be capitalized. Internally generated brand you cannot capitalize. If you have purchased any brand and have capitalized as asset, you need to inspect board minutes for authorization of purchase first. Inspect the purchase document regarding the amount of purchase. You can check useful life for amortization. Discuss with management regarding the chances of impairment, and you can verify cost cash paid against a purchase brand from cash book bank statement as well. And you can compare current year balances with previous year to investigate unexpected fluctuations. Accruals and prepayments, how we can verify that? Where they are mainly recorded, they are recorded in expense account. So check amount of accrued wages and salaries by comparing with payroll sheets. Check payments of accrued wages and salaries after year end from cash book. Might be company have recorded lower amount as a liability and paid more amount. If paid more, liability should be according to that amount. Because this is liability and company try to understand, state it. Consider with additional items should be accrued at the year end. For example, employees contribution, overtime bonus, mean we need to consider the accruals have been recorded properly or not. And we need to compare current year balances with previous year to investigate unexpected fluctuations. Accruals. No need to learn these procedures.
You go for
Well, no need to learn this. What you can do, review cash book and no, for cash book we have already written down. Compare current year balances with previous year, mean analytical procedure you need to write off that we are fitting in every account balance. How to verify previous contingent liabilities, etc. Compare current year balances with previous year to investigate unexpected fluctuations. Obtain a schedule of provision. If company has recorded so many provisions, obtain its schedule and agree to financial statements, means see whether all have been recorded into financial statement. Review list to ensure it included necessary item considering nature of business, like if business is providing warranty provision is there. Compare the list of provision with previous year to identify any major provision whose balance has been declined significantly so that we can inquire a reason why this has been declined. Especially the warranty provision. Either you have improved your quality, that's why warranty provision has been declined. If there is no improvement in quality, product are same, warranty should be same. Even if it's sale increasing, warranty should be more. Review whether provision have been adjusted in accordance with events occurring after the balance sheet, like any legal cases, any payments chances, and provision. Provision is a matters involving judgment estimate in their measurement. And matters involving judgment estimate in their measurement, we need to obtain written presentation from management regarding reasonableness of estimate and judgment. Completeness and adequacy of provision. No need to learn this. Or we can inspect minutes of the meeting of those charged with the governors to ensure how management considering the event. Like if there is any court case, if there is any penalty chances, so management will have to discuss in their meeting regarding how management consider it. Because through their discussion, we'll be able to identify the proper treatment. No need for this. Equity. Compare current year figure the previous year to investigate unexpected fluctuations. Agree authorized share capital. Where it is written authorized share capital. Constitutional document, memorandum of association, article of association, whether it is as per those or not. Authorized share capital of the company. That remains same throughout the life of organization. And while registering the company, you need to set in memorandum of association, article of association. If company have issued a share during the year, first you need to verify authorization or approval from board minutes review. Company have issued shares, company have received cash. Inspection of cash book bank statement regarding verification of cash receipt. Company have issued shares, so there should be some legal documents as well. So inspect supporting document like a share issue certificate or legal document. and recalculate, split the proceed mean amount received between nominal value of shares and premium discount so that we can check accounting entry properly. And if company have issued share during the year, there should be a disclosure in the financial statements to review the disclosure of a share issue to ensure they are in accordance with accounting standards. In accordance with accounting standards. What is a reserve?
Where it should have been.
You can say a reserve is retained earning. We can verify opening balance of reserve from where? Previous year financial statements. We can verify addition to reserve from where? Profit and loss account. Reserve means retained earning. The profit part that is not distributed to shareholder as dividend.
We can only use it when we have loss.
If there is a reduction, we can compare with income statement loss. If there is addition, we can compare with income statement profit. Even company need to pay dividend from where? Reserve. And we can compare current year balance with previous year to investigate unexpected fluctuation in why there is a change. Obviously, change is due to addition of current year profit or payment of dividend. How we can verify dividend paid? Board minutes, we need to review meeting of minutes to verify approval. Recalculate the amount of dividend. Ensure payment from cash book bank statement. And we need to check disclosure.
I'm share capital questions going because I haven't seen any challenge there, but
Is that?
I haven't seen any questions which have shared capital.
Yeah, there is no question rarely tested. Not tested, but just make up mind how we can verify. If examiner asks whether we will be able to write down 2 or 3 procedures, because they will not ask for 10, 8 marks, they will ask for 4, 5 marks maximum. Whether we'll be able to write down 2, 3 procedures so that we can get passing marks from this question. Because in exam, we should not try to pass the paper. We should try to pass each question. If you are trying to pass each question, each part of question, we can easily pass the paper. And if there is a 5 marks part, how I can get 3 marks from this? If there is a 10 marks part, how I can get 10 marks from this? If 16 marks, how I can get 8 marks from this? Because if we are passing each part, paper automatically passed. How to verify expenses? Compare current year balances with previous year to investigate unexpected fluctuation. Check the expenses requiring accrual has been accrued at year end. And if not paid during the year, so there should be liability. Expenses paid from where we can verify from cash book bank statement. For expenses, there are vouchers, so we need to compare with the supporting documents as well. For expenses, we need to check arithmetic accuracy by recalculation of amount. No need to see others. Compare current with the previous. If payment made, compare with cash book. If payment not made, compare with the accrual liabilities. And compare with supporting documents like vouchers to see they are genuine expenses for the business. If there are no vouchers, they are fictitious fake. And that's it. Let's take a break. After break, we will discuss two more bigger questions.
Okay, sir.
Let's discuss few more questions. Question 81, yes. Standard accounting standards. Okay. For this paper, you should be aware about IAS 2, inventory, IAS 38, intangibles, research and development cost, IAS 37, provisions, IAS 16, property, plant and equipment. As such, no other accounting standard is relevant for this paper. But in advanced audit, you should be aware about all the accounting standards. And we will discuss on that stage. IAS 16, property, plant and equipment, mean non-current assets. Is that fine? Let's move towards our question.
What's the last 10?
IAS 10, yes, events after the reporting date. Events after reporting date, especially in subsequent event question. Okay, let's move towards the question. Peach Company, question 81. There is a requirement A, requirement B, requirement C, requirement D. Requirement A. Describe 8 audit risks and explain the auditor's response to each risk in planning the audit of each company. Risk and response. This scenario relate to 5 requirements. Okay. It is 1st July 20x5. You are an audit supervisor with Apricot and Company, and you have been assigned to the audit of Peach Company. So the client name is Peach, a soft drink manufacturer which sells to wholesale customers. You are currently planning the year end, and for the year ending 31st August 20x5, you have received the following notes from the audit engagement partner. Materiality for the draft financial statements has been calculated as 153,000, which is a 5% of profit before tax. Mean based on 5% of profit, company have calculated the materiality 153. Mean below this, items will be immaterial. Above this will be considered material. Planning meeting notes. A new accounting system was introduced via direct change over in March 20x5. Company have changed or installed a new accounting system. It has been successfully tested prior to its implementation, and management had such confidence in the new system that they did not consider it necessary to undertake further testing after implementation. Firstly, during the year, company have changed a new system, mean they have installed, implemented new IT system. So due to early stage control weaknesses, chances that misstatements may not be prevented, detected, corrected by the system control risk will be high. Now detection risk, you can say detection risk might be auditor is not having a knowledge of cats. And due to lack of cats knowledge, computer assisted audit techniques, he may not detect a misstatement. He might not be having audit software or test data knowledge. So he may not detect misstatements. So there is a early stage control weaknesses and detection risk. One risk more. If you have installed a new system, might be the results of old system have not been completely transferred to new system. If the previous old system results are not completely transferred to new system, so figures could be manipulated. I mean, financial statement figures could be manipulated. Though you have tested while implementing, but now there is no testing performed. This means monitoring is not done on regular basis. So there could be some weaknesses which may not be prevented, detected, corrected by the system. Again, control risk. So mainly there is control risk, but you can also write detection risk. If there is a high control risk, your audit response should be more substantive approach should be adopted by the auditor. Because control risk high. If there is control risk high, there is no purpose of test of control. More substantive approach should be adopted by the auditor. I mean, this is the approach against control risk. And might be auditor not having a CAT's knowledge. So for this, auditor need to assess his skills to conduct the audit using CATs. This will be the response. Is that fine? Seems logical. Even while writing response, it is not necessary to write down the accurate procedure wording. You can simply write English, what you will review, what you will inspect. Even there is no need to write down accurate audit procedure wording. But if they are asking about the substantive procedure, in that case, you have to write down the procedure with proper wording. In response, there is no need to even use proper wording of procedures. What you will check, what you will verify, what you will review, you can write down as a response. Is it fine? So one risk we have identified relating to system. Each company has been developing a new production process, which will help to reduce sugar in its drink by 50%. Development commenced on 1st November 20X4. Year end was 31st August 20X5. I mean, during the year, they have started development. And the total amount capitalized was 0.8 million. What is materiality level? We can write even half sentence 0.8 million is material as compared to materiality. This will impress the exam. So we are finding risk, but if we are discussing half a line for materiality as well, because there is amount available, this will impress the exam. So 0.8 million regarding development cost capitalized is material. And as per IAS 38, development cost should be capitalized by using certain criteria. And if development cost not meeting the criteria, chances that asset profit could be overstated and expenses understated. On 1st May 2025, the Food Safety Authority approved the process and production of the new reduced sugar soft drink commenced. And the development cost should be amortized over its useful life. If company not amortizing development cost, chances that asset profit could be overstated, expenses understated. How we will verify this development cost? What we need to check? Commercial viability. What we need to check? Technical feasibility. So what we will do regarding technical feasibility?
Similar products.
Review existence of similar products in the market to verify technical feasibility. And review or inspect order book customer correspondence to verify commercial viability. Review board minutes to verify management intention to use computer set. Is it fine? And we can say review research and development cost schedule to verify correct classification of revenue and capital expenditure. Because research cost should be expense out, development cost should be capitalized by meeting criteria. So we need to review schedule of research and development cost to verify correct classification as revenue capital expenditure. And regarding amortization, what you will do? How you will verify amortization? Recalculate amortization using the rate policy and useful life. Compare with management calculation for accuracy. The same wording we will use for depreciation. Same wording we will use for amortization, recalculation of amortization, depreciation, using the rate policy, useful life, and compare with management calculation for accuracy. Done. Each company has inventories of high sugar drinks costing to 27,000 and inventory amount is material as compared to 153,000. Which it can no longer sell CLL in its home market due to lack of demand. The director believes each company can sell the remaining inventory to an international customer at a price that marginally exceed cost. But each company will be responsible for all costs relating to delivery and shipping the drink. This means there will be more cost to sell. So chances that NRV, net realizable value, is lower than cost. And if company not recording as per IAS2, lower of cost and NRV, inventory profit could be overstated and expenses understated.
And assets also.
Inventory asset profit could be overstated and expenses understated. What will be the response? What we need to do? Compare NRV and cost of inventory. Compare NRV and cost of inventory to ensure inventory recorded on lower amount. Discuss with management their intention to sell this inventory either on international or local market. Because if they don't want to sell in international, local market, there is nothing. So amount should be zero. So discuss with management their intention to sell this inventory either on international or local market and detail about the delivery expenses. Because there is issue of delivery expenses as well and detail about delivery expenses. In these things we will discuss with management to see if reasonable. Is that fine? Response. You have to practice 3-4 questions before going to paper. Otherwise, you will not be able to write down even a single response. Each company replaced 2 items of machinery in its production line to accommodate a change in the type of bottle they use. There were significant staff costs involved in preparing the site for new machinery and in testing that the new machinery was operating correctly. These costs have been included within wages and salary expense for the period. For IA 16, property, plant and equipment, all the cost incurred to bring the asset into its present condition location should be capitalized. If these costs are necessary, without testing that machinery cannot be used, without using the staff to install that machinery cannot be used, so they should be capitalized rather than charging to wages and salaries. And if by meeting capital criteria, company charging to wages and salaries, chances that asset profit could be understated and wages and salary expenses could be overstated. है ना? Is that? Not only asset could be understated, there could be chances that depreciation expense could also be understated. Because if asset amount is lower, you will charge lower depreciation. Despite the old machinery being sold at a significant loss, old machinery sold at loss. Why asset sold at loss? This means you charge more depreciation or less depreciation. Less depreciation mean you estimated useful life more while estimated life was less. In fact, the life was less. Mean instead of depreciating asset over 5 years, you have depreciated over 8 years. That's why even there is no profit on sale, there is a loss. So despite the old machinery being sold at significant loss during the year, the directors of each company decided to extend the useful life of plant and machinery by an average of 5 years. Mean they are extending the life. Mean instead of depreciating on 8 years, now they are going to depreciate on 13 years. Why? So that depreciation expense should be lesser and they can overstate profit and asset. While there is evidence your previous asset sold on loss. This means the useful life actually is lesser than your estimates. That's why there is a loss. The actual useful life is lesser than your estimate. Mean might be asset should have been depreciated over 5 years, but you depreciated over 8 years. That's why there is a loss. And with having this evidence, you are now extending even life more instead of reducing. So there are two issues. One issue is relating to this. Mean you have wrongly misclassified the cost that should have been capitalized. You have charged it to wages and salary. And for this, we can write down the response. What should be the response? Discuss with the management regarding the classification of capitalized cost to wages and salary to see if reasonable mean why they are charging to them. And what else we can do? Review breakdown of revenue and capital expenditure. Compare with the invoices. Compare with invoices to verify nature of expense. Whether these are relating to revenue or capital. So we will review a breakdown of revenue and capital expenditure. Review breakdown of revenue capital expenditure. Review breakdown. Breakdown mean a page where revenue capital expenditure have been recorded of capital and revenue expenditure and compare with relevant invoices to ensure exact nature of expenditure. And we can discuss with management why capitalized nature expenditure have been charged to wages and salaries to ensure if reasonable. And there is other issue. What is other issue? Management have changed the useful life. And they have increased useful life despite being evidence previous assets sold on loss. Mean your previous asset sold on loss is giving evidence like your previous life was even more. And now you have extended more 5 years. So chances that management want to depreciate lower amount to overstate asset profit and understate expenses. What we will do? Discuss with management the reason behind extending useful life to see if reasonable. Consult independent expert regarding useful life of the asset. And what else we can do? Recalculate depreciation using the useful life policy method and compare with management calculation for accuracy. First, we need to discuss with management the reason behind extending useful life to see if reasonable. I mean, they will provide justification. We will see whether that their justification is reasonable or not. And we can also consult expert. So consult independent expert regarding verification of useful life of asset. Mean they will tell you whether this asset can be used for these years or not. And then we will recalculate the amount of depreciation using the rate, policy, and useful life and compare with management calculation for accuracy. So there are two issues. One is relating to capitalized cost. Other is relating to extending useful life. A member of the finance team was dismissed by Peach Company in May 20x5 after it was discovered that they had been fraudulently purchasing non-current assets for personal use. Finance team member fraudulently purchasing company non-current assets for personal use. Peach Company started to investigate the fraud at the beginning of June 20x5 by reconciling all physical assets to the non-current asset register, but will not have completed the reconciliation by the year-end date.
That means you can't use it.
This means there could be chances some of the asset not existing in the business. Mean the finance team member have misused for personal use, but still in the accounting records. Due to this, asset could be over or understated. Overstated, because they are in the record but not physically present because finance team member has misused in personal use. Is that how we can verify overstatement of asset, whether asset exists or not? Physical inspection of the asset to verify their existence. And there is a fraud. So we need to perform fraud risk factor as a high. We need to consider fraud risk factor as a high. Because fraudulent activity. So fraud risk factor should be considered as high, resulting into increase in professional skepticism. So fraud risk factor will be considered high, resulting into increase in professional skepticism. And for existence of asset, we will perform physical inspection of the asset to verify its existence. Because there are chances some asset not existed, but available in the record. In the record mean recorded in the financial statement. Due to that, asset could be overstated. That is a risk. So physical inspection of the asset to verify existence and consider fraud risk factor as a high to increase professional skepticism of the audit. Each company entered into a contract on 1st May with a new supplier of bottle. Each company has committed a minimum order quantity of 150,000 bottles per month for a period of 12 months commencing 1st May 20x5. In the made a contract with supplier, we will keep your inventory of 150,000 in our store. But they have committed a entered into a contract. No costs have been accounted for to date as no amounts are payable for the first 6 months. And they didn't pay the amount for first 6 months to the supplier. 3 equal installments are then payable across the remainder of the contract term. Peach Company previous supplier has launched a legal claim against Peach Company for breach of contract, stating that Peach Company didn't have the right to exist the agreement early. Mean this contract is in breach with the previous supplier. And they have filed a legal claim for the damages. Exactly. So Peach Company lawyer have indicated that it is likely to lose the case. Probability, future economic outflow, and have estimated the amount payable to be in the region of 3 million, 0.3 million. And 0.3 million is a material. So for IAS 37, there is a condition of provision meeting this issue. And if management do not account for provision, chances that expenses, liabilities could be understated and profit overstated. Who is saying there is likely to be payment? Mr. Lawyer. What the procedure will be right now? Consult the lawyer to verify likelihood of the payments made. And they have launched a legal claim. So we can review the copy of legal claim to verify the severity of claim. Severity means whether the chances are high or low. Is that fine? We need to consult the lawyer regarding identification of likelihood of payment and review legal claim copy to verify severity of claim. And we can also discuss with management regarding their intention or their treatment of this matter in the financial statements, mean how they are going to account for this matter in the financial statement, whether they are going to create provision or not. In order to fund the development of new production and purchase of new machinery, Peach Company obtained an interest-bearing bank loan of 1.2 million on 1st March 20x5.
The cost per month not been recorded.
And due to that, liabilities could be understated. So payables could be understated, so we need to reconcile payable ledger with the supplier statement to investigate the differences. Payables procedures. So company have obtained interest bearing bank loan of 1.2 million on 1st March 20x5 and the year end is 1st August 20x5. Repayable over the next 3 years in arrears. In arrears mean current will be paid in next. This means current year interest will be paid in next, but should be recorded in current year. Should be accrued for in current year. Accrued for mean expense to liability. And if interest is not accrued for in current year, chances that expenses, liabilities could be understated and profit overstated. In order to secure the bank loan, each company agreed to maintain a minimum net profit margin and meet specific sale target. So first there is an issue, interest is not recorded. How we can verify interest is recorded or not? How much is the interest? Recalculate the interest using the loan agreement interest rate and compare with management calculation for accuracy. Review financial statements, interest have been recorded properly. And loan is having a condition that company need to fulfill minimum net profit margin and company need to fulfill sale target as well. And if company is not meeting the condition of maintaining net profit margin or sale target, bank can recall the loan. And to avoid recalling or action of a bank, there are chances sales could be overstated. How we can check sales are overstated or not? We need to perform cutoff procedures. Sales could be overstated due to cutoff. So we need to perform cutoff procedures and we need to verify occurrence of sale by tracing a sample of sale ledger balances to relevant invoices, dispatch note, and orders. This is the response. Is that? How many risks are there? In first paragraph, we have identified control risk. In second paragraph, we have identified development cost. In third paragraph, we have identified inventory. Then we have identified non-current assets, misclassification of revenue capital expenditure, change in estimate, mean useful life. Here we have identified asset understatement due to fraud. And here we have identified provision. Here we have identified interest as well as overstatement of sales. Requirement B of the question. Describe apricot company's responsibility in relation to the prevention and detection of fraud and errors. Auditor's responsibility in relation to prevention, detection of fraud and errors. Is there any responsibility of the auditor? Yes. Auditor need to design audit procedure with expectation of a fraud. Auditor need to assess risk of material misstatement due to fraud. What else? If there are any chances of fraud, auditor need to increase its professional skepticism. If there are chances of fraud, auditor need to adopt more substantive approach rather than system-based approach. We can write down 4 points. Part C. Identify and explain two ethical threats which may affect the independence of apricot company audit of peaches company. Mean threat question can be asked in this form as well, where we need to write down about threat. And for each threat, recommend an appropriate safeguard to reduce the threat. Mean mitigation, safeguard, how auditor can reduce the threat. But for 4 marks only. Apricot company has been an audit client of Apricot company for the last 15 years. Due to long-standing relationship, there will be familiarity that affecting independence, objectivity of the audit. What we need to do, what is the safeguard? Auditor should be rotated of the auditor every 5 years. Key audit personnel must be rotated of the audit every 5 years. The audit staff of apricot company and the client staff of peach company have always enjoyed a meal together at the start of the final audit. Alan Edward, the managing director of Peach and Company, has this year suggested that instead of a meal, all the audit staff and audit client staff go away for the weekend to a luxury hotel at a Peach Company expense. So this is undue hospitality, creating self-interest as well as familiarity threat, affecting independence, objectivity of the audit. What should be the safeguard? Client should be requested not to provide this kind of hospitality to the audit staff. Audit staff should be instructed not to avail this kind of hospitality from the audit client. Meal together is acceptable because it is not significant, but make sure auditor team should have paid for their meal. Even this meal should not be from client pocket because they are paying you fee for your work. They are not your mummy, daddy, like paying for your meal as well. You know, we shouldn't have any other interest other than our fee that we are charging for the services. Meal, entertainment, we should pay from our pocket. Alan Edward has also suggested that the current year audit fee is renegotiated to be based on a percentage of each company net profit for the year. Your audit fee will be based on percentage of profit, contingent fee, percentage fee, self-interest as well as intimidation threat can pressurize the auditor. If profit is lesser, I will get lesser, profit should be more. So what should be the mitigation? Auditor should not work on contingent or percentage fee. The fee should be fixed and decided before starting the audit work. This year, for the first time, Apricot and Company has been approached by Peach Company to help identify potential target. Mean client want to acquire any target company and they are asking you to help in acquiring target company. Mean they are going to buy a subsidiary business. Discussions are currently at the early stage and no work has been undertaken at present. So if you are providing this kind of services, the client want to acquire any business and you are guiding the client, this is called advisory services, which create advocacy threat, affect independence, objectivity of the auditor, even self-review threat because the business they are going to acquire will be consolidated into the financial statements that you will be auditing. So we can provide this kind of services, but with the Chinese wall, separate team for audit, separate team for non-audit. The total fee in relation to the audit and other work would fall within not fail, fall within acceptable level in line with ACCA codes of ethics and conduct mean there will be no fee dependency issue, but there is advocacy threat. But we need to identify two only. Part D of the question. Describe substantive procedure to the auditor should perform to obtain sufficient appropriate audit evidence in relation to each company development expenditure. Compare current year balances with previous year to investigate unexpected fluctuations. Review board minutes to verify management intention to use, complete, or sell this. Review existence of similar products in the market to verify technical feasibility. Review customer correspondence order book to verify commercial viability. How we can verify resources? Review cash flow forecast to verify financial resources are available. Review budgets copy or cost card to verify cost can be measured reliably. Review breakdown of research and development expenditure to see research cost has been expensed out and development cost has been capitalized. Recalculate amortization of development costs using the rate, policy, and useful life and compare with management calculation for accuracy. And there was an issue, they might be deciding a different life. So discuss with management regarding the useful life of the asset, development cost to see if reasonable. For 6 marks is difficult. After writing 2-3 procedures, you will be blank. But if you have make practice, written practice, you'll be able to write. That's why written practice is mandatory for these questions. Okay, let's discuss another question. Long-term liabilities, we have already covered. Long-term liabilities.
Yeah,
Long-term liabilities compare current with previous year.
we start from class, January.
Is there any issue with that? Let me check. Non-current liabilities, where are they?
Yeah, you give us the solutions and one to detail.
We have already covered these
That's
things. See, these are underlined. This means we have covered.
You explained this way. Is that all that's?
Yeah, that's fine. That's fine. Here we go. Okay, let's discuss one more question. Question 80. Hurling company. What we need to do? Define audit risk and components of audit risk. What is audit risk? What is inherent risk? What is control risk? What is detection risk? Straightforward. Forward definitions for 4 marks. And part B, describe 8 audit risks and explain the auditor's response to each risk in planning the audit of hurling company. And part D, you need to find 5 ethical threats and a safeguard for 10 marks. These are easy marks. These 4 are easy marks. But these 16 are technical marks.
Oh, what are the components of audit risk?
Inherent risk, control risk, detection risk. Mean you need to provide 4 definitions. So audit risk and response. It is the 1st July 20x5. You are an audit supervisor of a Caving and company, and you are planning the audit of hurling company, unlisted company, for the year ending 30th September 20x5. Year end is 30th September 20x5. The company manufactures computer components and forecast profit before tax is 33.6 million and total assets are 79.3 million. Hurling company distributes its product through wholesaler as well as via its own website. The website was upgraded during the year at a cost of 1.1 million. So there could be early stage control weaknesses due to which might be website not performing well, not recording transaction accurately. So chances of manipulation in financial statement. Control risk is high. We need to adopt substantive approach, especially over the income through website. Additionally, the company entered into a transaction in August to purchase a new warehouse, which will cost 3.2 million. Hurling Company's legal advisor are working to ensure that the legal process will be completed by the year end. The company issued 5 million of irredeemable preference shares to finance the warehouse purchase. There are three issues in this paragraph. First is a newly installed website. And the cost is 1.1 million. So there could be chances some revenue expenditure are also capitalized as a website cost. So we need to review breakdown of revenue, capital expenditure, and compare with the invoices to identify nature. And there is another issue. Company have purchased 3.2 million warehouse during the year. And Hurling Company's legal advisors are working to ensure that the legal process will be completed by the end this year. Might be registration process is not completed till year end. And if registration process is not completed till the year end, whether company own this asset? No. And if company do not own and company have recorded warehouse as asset, the asset could be overstated. How we can verify ownership of asset? Inspection of legal documents like title deeds, registry document to verify ownership at the year end. Response. There is third issue. Company have issued irredeemable preference shares to fund this investment. There are two types of preference shares: redeemable, irredeemable. Redeemable means company will pay back to the holder. Irredeemable, company will never ever pay back to the investors. Redeemable preference shares should be recorded as a non-current liability. Irredeemable should be recorded as equity. There are chances company may misclassify irredeemable preference shares to non-current liabilities rather than equity. And due to this misclassification, non-current liabilities could be overstated and equity could be understated.
Is it supposed to notes as well?
It's mentioned in the answer of this question. Irredeemable, redeemable preference shares is not in our notes. But examiner sometimes asks for one to mark this kind of out of book question as well. They are assuming you are coming after knowledge of financial accounting F3. So we know there are two types of preference shares. Redeemable should be recorded as a loan, long-term liability, non-current liability. Irredeemable should be recorded as equity. And if there is misclassification, chances that long-term liabilities could be overstated and equity could be understated. How you can verify this? Review financial statements to verify correct classification of irredeemable preference shares into equity. Even if you skip this, you will still be able to identify 8 audit risk. There is a margin in this question. Because we are finding 10, 11, 10, 11. This means if you skip one of like this, even still, you are completing the question. Because we don't need to identify extra. Okay, so there are three issues in this paragraph. During the year, the finance director has increased the useful economic life of fixture and fittings from 3 to 4 years, as he felt this was a more appropriate period. The finance director has informed the audit engagement partner that a revised credit period has been agreed with one of its wholesale customer, as they have been experiencing difficulty with repaying the balance of 1.2 million owing to Hurling Company. So there are two issues again. First issue, they have changed the estimated useful life of the asset from 3 to 4 years. This could have been done to overstate the asset as well as profit, because changing life will result into lower depreciation. So through lower depreciation, chances that asset profit could be overstated and expenses understated. What we will do? Discuss with management the reason behind change the useful life to see if reasonable. Consult independent expert regarding useful life of the asset. Recalculate depreciation using the useful life and compare with management calculation for accuracy. But the second issue, they are struggling to receive money from their customer. If they are struggling, might be company have not created provision for doubtful debts. Customer is struggling to pay, they are struggling to receive. Not 1.2 million is not that much amount. Customer is experiencing difficulties, not a way. If he is having going some issue, might be will not be able to recover. There are chances of bad debts. If do not adjust it receivable, chances that asset profit could be overstated, expenses understated. How we can verify this? Inspection of post year and cash receipt to ensure cash has been received from the customer. Because if not bad debts recorded, not cash received, then we will say record bad debts. Perform circularization to confirm the balance or review any correspondence with the customer to verify chances of recovery. In July 20x5, Hurling Company introduced a new bonus based on sale target for its sales staff. This has resulted in a significant number of new wholesale customer accounts being opened by sales staff. New customers have been given favorable credit terms as an introductory offer, provided goods are purchased within a 22 months period. As a result, revenue has increased by 5% this year. So due to this, even receivables could be overstated because they are providing 2 months credit period. But as the bonus are linked to sales target, there could be chances of sale could be overstated due to cut-off errors. Due to cut-off errors, mean next year sale could be recorded in current period. Or chances fictitious sale, fictitious wholesale customer account created to overstate the sale. That will be adjusted after the year end with fictitious sale return. What do we need to do? Verify occurrence of sales and receivables by comparing the balances with the sales invoices, dispatch note, and sales orders. What else? Cut-off test must be performed to compare GDNs with the invoices and ledger balances to ensure sales receivables have been recorded in their correct period. And post year end sale return should also be reviewed to see they have been adjusted with their correct ledger balances or correct period ledger balances. Is it fine? The company has launched several new products this year, and all but one of these new launches have been successful. Feedback on product Liu launched 4 months ago has been mixed, and the company has just received notice from one of their customer, Fentank company, of intended legal action. They are alleging the product sold to them was faulty, resulting in significant loss of information and on ongoing detrimental impact on profit. As a precaution, sale of the Lug product have been halted, and a product recall has been initiated for any Lug product sold in the last 4 months. There are two issues. First, customer have charged for penalties, legal action. So if it's meeting all the criteria of IAS 37 provision, there should be provision recorded. If company is not recording provision, chances that expenses, liabilities could be understated, profit overstated. Audit response should be review of legal claim copy to verify severity of claim. Consult a lawyer of the company to ensure likelihood of payment. Discuss with management regarding the treatment of this event in the financial statement. And there is a second issue. Company is still having that faulty inventory in their inventory record. That is faulty. This means their NRV will be lower than the cost. And if that faulty inventory is not adjusted properly, chances that inventory balances could be overstated. Now we can verify how much inventory of this lug type is there. Review latest inventory count sheets to verify the amount of quantity and amount of inventory still available in the warehouse requiring adjustment. Discuss with management their intention to sell this inventory either on discount, offer, etc.
Government like the refund.
To whom? They are what they are doing. They are recalling the product.
So that means a refund daily.
Obviously, they are recalling. After recalling, they will making a refund. That is a future.
So does that require a provision?
But why they are recalling? Because that inventory is going to be down. That's the main issue. The finance sector is keen to announce the company's financial results to the stock market earlier than last year, and in order to facilitate this, he has asked if the audit could be completed in the shorter time scale. In if finance sector asking you, we are going for listing on a stock exchange. Can you complete your audit a little bit earlier? Might be they require audit report in favor of the company. So this could create pressure on the audit work, time pressure, and due to that time pressure, auditor may not detect misstatements. Detection risk will arise. What should be the audit response? We need to plan our audit properly by considering the time limitations. Auditor should start audit a little bit earlier, like he should verify some account balances during interim audit so that there shouldn't be time pressure in the final audit. And we need to consult with those charged with the governance regarding concern of these kind of time pressure to resolve it. In addition, the company is intending to propose a final dividend once the financial statements are finalized. Proposed dividend. What does mean by proposed? Deciding.
Mentioned for the
Dividend should be recorded in the financial statements when it is paid. Proposed should be disclosed, not should be accounted for. So chances that proposed dividend is accounted for will result into manipulation in financial statement. What could be the audit procedures? Review financial statements to verify proposed dividend is not accounted for. Only we can review financial statement. Hurling Company Finance Director has informed the audit engagement partner that one of the company's non-executive director has just resigned. And he has inquired if the partner at Craving Company can help Hurling Company in recruiting a new non-executive director. This is threat. The recruitment of company management personnel is the responsibility of company management rather than auditor. If auditor is involved in recruitment of any management person of client company, he is performing management level function, creating advocacy threat, which will affect independence objectivity of the auditor. Though client recruitment facilitations are not prohibited, we can perform these services as a separate, but through Chinese walls, means separate team for audit, separate team for these non-audit services. Especially, he has requested the engagement quality reviewer who was until last year the audit engagement partner on Hurling Company assist the company in this recruitment. Caving and Company also provide taxation services for Hurling Company. Self-review threat. Separate team. In the form of tax return preparation along with some tax planning advice, tax advisory services, advocacy threat. Again, separate team. The finance director has recommended to the audit committee of Hurling Company that this year audit fee should be based on company's profit before tax. Contingent percentage fee, intimidation, self-interest threat. At today's 20% of last year audit fee is still outstanding due to overdue fee. Again, self-interest threat should have been recovered or resolved before starting the next work and was due to be paid in 3 months ago. Mean we need to identify 5 threats and mitigation, and this paragraph is written that. Is that fine? And I will share one mock. On Sunday or Monday will be fine. You're having paper on Wednesday, na?
Sunday.
Monday. So prepare properly till Sunday night.
I know. Monday points. That's right.
Okay, Sunday I will share.
Yeah.
So please try to attempt that mock paper. And if possible, share the pictures of that mock into PDF with me.
Word document.
Sorry,
Word documents from.
Word document file mean try to take the picture. Word document file will be fine. Convert it into PDF and send to me.
We type down.
Yeah, you can type the answer. MCQs, you can type the option. Try to attempt the paper, mock paper in a Word file, convert it into PDF and share with me so that I can check.
Yeah.
So there'll be no class. If you need any help, I'm available on emails, I'm available on Teams, I'm available on WhatsApp, on call, even I'm available in campus. But before coming to campus, confirm with me. So wish you best of luck.
Thank you, sir.
Hope to not see you again in this paper.
Okay, thank you.
Hope to see you again in upcoming papers. Somebody will take FR. Good teacher. Okay, Ragi, Sagar,
Okay, sir. Thank you. Thank you
best
so
of
much.
luck. See you next.
And law.